Welcome to the session on budgetary control and cost volume profit analysis. Let me introduce you to the topic. Friends, planning is very important function and roadmap to movement without which it is not possible to reach destination. Budget is a financial planning. It is a plan for future action. Planning in monetary terms is important whether it is household or business activity. A household budget depicts plan with respect to generation of income from different sources and expenditure heads under various activities of a family like health, food, clothes, education, traveling, household routine expenses and so on. Similarly, business entities' budgets depicts plan for the future business activities. It shows estimated sources of finance and income sources for business concern and details of how funds would be spent on various functional areas of business. Friends, this session deals with the introduction to budget, budgetary control, advantages, disadvantages, classification and types of budget. Let us see the objectives of the session. The objectives of this session is to make you understand concept of budget, budgeting and budgetary control and its importance. The session will also make you understand the objectives, advantages and disadvantages of budgetary control. Another objective is to explain you classification of budget and concepts like zero-based budgeting, master budget and performance budgeting. Let's start with the meaning of budget, budgeting and budgetary control. Let us see what is budget. Budget is a planning in financial terms. It is plan in monetary terms covering specific future period of time. Budget is an estimation well in advance in monetary terms. While preparing budget, one has to plan in monetary terms considering all the aspects of business and all functions of business. It prescribed guidelines to achieve the objectives of the firm. Let us understand budgeting. Budgeting is a process of preparation, implementation and execution of budgets. It tries to solve problems that may arise during operations. It is a process of allocation of resources. Budget needs to be prepared and approved prior to a defined period of time, showing planned income and expenditure to be incurred during that period in a given capital to be employed for attaining specific objective. What is budgetary control? It is a system of planning and controlling cost. Budgetary control is mechanism of establishing budgets relating the functions in organization and continuous comparison of actual with the budgeted results so as to control the business firm and thereby achieving objectives of business. The budgetary control involves preparation of budget, measuring actual performance, compare actual performance with budgeted performance, find out deviations and analyze the reasons for variations if any, preparing right action plan at right time to remove deviations to achieve ultimate goal of business and revision of budget if needed. Friends, now let us understand what are the objectives of budgetary control. Budgetary control serves the planning, coordination and control function. It facilitates centralized control. For preparing budget, different level employees in organization work in a unified manner and cooperative manner to achieve the goals set by budget. Goal congruence is possible due to budget. Budgetary control will also help in better profitability as comparison with standard performance on actual continuous basis. The budgetary control facilitates coordination between departments. No department can prepare budget in isolation, as while preparing budget, coordination between different departments like production, marketing, human resources, purchase, accounting, finance and so on needs to be done. Budget also aims at proper execution of activities and comparisons during intervals so that deviations can be identified. Friends, budget also facilitates the task of the revision of budgets. Now let us understand advantages of budgetary control. Firstly, budget serves as an aid in making and coordinating short-range plans. Second advantage is it is instrumental and serves as a device for communicating these plans to different functional area employees. Thirdly, it serves as a benchmark for the control of ongoing activities at different levels in organization. Fourth and important is it provides a base for evaluating responsibility centers, managers, departments and various levels in organization. Fifth is it serves principles of management by exception. The deviations are looked into through various variance analysis and reports are prepared accordingly for further actions. Next is budgetary control leads to correct deviations from the predetermined target by reviewing at various stages. Friends, many a times it also helps to revise fundamental goals, policies and procedures of business. Another advantage is it serves as motivating tools for managers to achieve goals. It also serves means to educate managers. It also leads to goal congruence in an organization. Let us understand disadvantages of budgetary control. Friends, budgetary control is based upon estimation. It starts with making monetary estimation. The estimates may not be accurate. Secondly, in changing economic conditions, budget may fail. Planning well in advance may fail because of any change in external factors like changes in inflation rate, changes in the government policy, changes in natural environment factors. Thirdly, proper coordination and communication between budget committee is also very important factor. Friends, many times in large organization, coordination between budget committee members from different departments may not be possible and thus it may lead to failure of budget. Another disadvantage is the time limit set by budget may not be realistic. Any change in external factors will influence the firm and so set time limit may not work. Next is many times budget may have too many regulations, detailed requirements for implementation of estimated targets leading to counterproductivity and no flexibility. Now let us understand classification of budget. Friends, different types of budgets have been developed keeping in view the different purposes. Some of the important classifications of budget are discussed here. First is classification according to time. Based on the time factor, budgets are broadly classified in the following three types. First is a long-term budgets. Friends, the long-term budgets are those which are prepared to show the long-term planning of the organization. This budget is prepared normally for a period of 5 to 10 years. For example, capital expenditure budget, research and development budget, long-term finances, and so on. Second is short-term budgets. Short-term budgets are those which have to be prepared for a period of 1 or 2 years. Example, operating budget, cash budget, material budgets, etc. Third is a current budget. Current budget is one which has to be prepared for a very short period, say a month or a quarter, and is related to the current conditions. Now, the second category of classification is according to function. Friends, a functional budget is a budget which relates to any of the functions of an organization. The functional budget depends upon the type of functions performed in an organization. The functional budget are categorized like this. First is sales budget. As the name suggests, sales budget is a forecast of total sales volume during the budget period. It may contain the information regarding the sales unit-wise, month-wise, product-wise, and area-wise. This budget is prepared by the sales manager. Second is production budget. Friends, production budget refers to the budget for the production activities of the firm. Preparation of production budget depends upon the sales budget. The objective of this budget is to determine the quantity of production for a budgeted period. In other words, it is the quantity of units to be produced during a budget period. Third is material budget. Material budget is an important for an organization. Material procurement budget is an estimation of quantities of raw material to be purchased for production during the budget period. It is very important for organization to formulate effective purpose policy of raw materials. Material budget should be prepared normally taking into account different factors like availability of finance, storage facilities, price trends in the markets, and so on. The fourth is labor budget. Friends, labor budget shows the total hours required to complete the production activities and target. Labor budget is a budget which is prepared by the personnel department of the organization. It also shows the cost incurred for the labor used for the production. Next is factory overhead budget. This budget indicates the estimated cost of indirect materials, indirect labor, and indirect factory expenses incurred during the budget period. This budget is classified into fixed, variable, and semi-variable. Sixth is administrative expenses budget. Administrative expenses budget estimates the amount required to meet the administrative and operational activities of the organization. This budget will provide proper guidance and estimation for the expenses incurred in the budget period. Seventh is selling and distribution overhead budget. This budget is prepared by the sales manager of each territory. It indicates an estimation of administrative expenses to be incurred in the budget period. Preparation of selling and distribution overhead budget depends upon the sales budget. Eighth is capital expenditure budget. Capital expenditure budget is a long-term planning for the proposed capital outlay and its financing. Capital expenditure is an expenditure which has to be incurred for the purpose of acquiring benefit not only for the particular year but also for the subsequent period of 5 to 10 years. Capital budgeting is also known as investment decision making, which is very important for the organization. Ninth is cash budget. Friends, cash budget refers to the estimation of cash receipts and payments and balances during the budget period. Cash budget is prepared by the chief accountant of the organization. It may be prepared either monthly or weekly. 10th and important is a master budget. As the name suggests, master budget is the sum of total of company's budget that includes allocation of funds to different activities of the business. The definition of this budget given by the Chartered Institute of Management Accountant England shows that the summary budget incorporating its component functional budgets and which is finally approved, adopted and employed. Friends, master budget is otherwise called as finalized profit plan. Normally, it has to be approved by the board of directors before it is put into operational activities. The master budget is prepared after including different factors like sales, operating expenses, operating and other income sources, working capital and so on. Managers in the company has to work in line with the master budget. Let us look into another classification, that is classification according to flexibility. According to flexibility, it is divided into different categories. First is a fixed budget. A fixed budget is prepared for a fixed level of activity and a prescribed set of conditions. It has been defined as a budget which is designed to remain unchanged irrespective of the volume of output or level of activity actually attained. It does not consider any change in expenditure arising out of changes in the level of activity. Second is a flexible budget. Flexible budget is otherwise called as variable budget. The Chartered Institute of Management Accountants England defines a flexible budget as a budget which, by recognizing the difference in behavior between fixed and variable cost in relation to fluctuations in the output, turnover or other variable factors such as number of employees, and is designed to change appropriately with such fluctuations. The flexible budget is prepared when the business is new one, when sales are changing very frequently and where the industry is very influential due to external factors. Let us understand now zero-based budgeting. Friends, zero-based budgeting is defined as a planning and budgeting process which requires each manager to justify his entire budget request in detail from scratch, hence zero base, and shifts the burden of proof to each manager to justify why he should spend money at all. The main objective of zero-based budgeting is the cost reduction and optimum utilization of resources. The zero-based budgeting requires determination of objectives and extent of application, identifying decision-making units and do cost-benefit analysis and preparation of budget. Let us understand now what is performance budgeting and performance report. Friends, performance budgeting technique is the process of analyzing, identifying, simplifying and crystallizing specific performance objective of a job to be achieved over a period in the framework of the organizational objectives. Any type of budgeting must provide performance appraisal as well as follow-up measures for success. Without performance appraisal and follow-up measures, the budget will never be successful. Performance report is prepared on the basis of the evaluation of budget. The report contains performance activities and the progress of the activities of the organization. Now, let us understand a concept of cost volume profit analysis. Cost volume profit analysis, known as CVP analysis, is an effective tool of profit planning. The determination of profitability is important and essential part of an accounting process. For managerial decisions, a careful analysis of the behavior of cost and profits as a function of expected volumes of sales is very vital to make important managerial decisions. Friends, CVP analysis aims in determining the effect that a change in volume, cost price and product mix will have no profits. This analysis is based on the assumption that the volume of production drives cost and revenue. CVP analysis requires interaction of many factors: the volume of sales, selling price, product mix of sales, variable cost per unit. CVP analysis plays very important role in the activity of a business. It assists in framing the pricing policies of products. It assists in evaluation of profit, cost incurred and the like, which facilitates the task of the cost control. It also assists in planning for cash requirements at a given volume of output. It is very helpful in setting up flexible budgets which indicate acts at different level of activity. Next is break-even analysis. Break-even analysis is one of the important technique to formulate the profit planning. It is a technique which shows the profitability or otherwise of an undertaking at various levels of activity and as a result indicates the point at which sales will equal total costs. The break-even analysis depicts different level of information which includes variable cost, fixed cost, total cost, sales value, break-even point, profit or loss. Break-even analysis is very important for the managerial decisions. Break-even point. Friends, break-even point determines the level of activity where there is neither profit nor loss. It denotes activity level where cost equals revenue. If we want to derive a formula, we can say that break-even volume is equal to fixed cost divided by contribution per unit, where contribution is equal to sales minus variable cost. So, if we want to derive in totality, break-even point is equal to fixed cost divided by sales minus variable cost. Now, let us understand margin of safety. Margin of safety is excess of sales over and above break-even point. It is difference between the actual sales and the sales at BP. If the actual sales is beyond break-even sales, it would lead to profit. Thus, it will indicate the strength of business. If we want to derive in a formula, we can say margin of safety is equal to total sales minus sales at BP. Friends, higher the margin of safety, higher is the profit. Low margin of safety will indicate lower profit. For right margin of safety of a firm, management should try to reduce fixed cost and variable cost. The company should try to increase sales volumes and, if possible, sales pricing also. Now, let us understand angle of incidence. Friends, the angle of incidence is the angle between the total cost line and the total sales line. If the angle is large, the firm is said to make profits at a higher rate and vice versa. A high angle of incidence and a high margin of safety indicate sound business conditions. A small angle of incidence and a low margin of safety indicate variable cost constitute a major chunk of cost of sales. Friends, if angle of incidence and margin of safety are considered together, results will be more profitable. Now, let us look into what are the applications of cost volume profit analysis. Friends, the CVP analysis is useful in determining optimum selling price, helps in profit planning, it helps in new product decisions, it assists in planning for sales requirements, it assists in evaluation of profit and cost controls, it helps in determining profitability of each product. Inter-firm comparison of profitability among firms can be easily made to assess the prevailing conditions in the market. It helps in deciding alternative decisions like make or buy, continue or shut down, and so on. It is helpful in setting up a flexible budget indicating cost at different level of activity. It helps in cost control and helps in analyzing modernization or automation programs of enterprise. Now, let me summarize the session. Friends, budget is the estimation in monetary terms. During the session, we have learned that budgetary control is very important for controlling the system of organization. Budget can be prepared on the basis of time, function, flexibility, and others. Some organizations go for zero-based budgeting and others may go for performance budgeting too. Zero-based budgeting is preparing budgeting from zero, that is, taking base as zero. Performance reports are important for analyzing the performance of the firm. We have seen that CVP analysis is another important technique. CVP analysis aims in determining the effect that a change in volume, cost price and product mix will have no profits. This analysis is based on the assumption that the volume of production drives cost and revenue. We have seen that CVP analysis requires interaction of many factors like the volume of sales, selling price, product mix of sales, variable cost per unit and so on. We have also seen that break-even analysis is one of the important technique to formulate the profit planning. It is a technique which shows the profitability or otherwise of an undertaking at various levels of activity and as a result indicates the point at which sales will equal total cost. Friends, we have also learned the meaning of margin of safety and angle of incidence. The application of CVP analysis has also been covered in this session. Hope the session has given you great learning of the concepts of budgetary